Hello students, welcome to EPG Pathshala. I am Dr. Sanjeet Sharma from Government College Nidon, Himachal Pradesh. Today we are going to talk on module preparation of profit and loss account from paper Accounting and Financial Analysis. After studying this module, the students may able to know the purpose of preparing profit and loss account to identify the items debited and credited in profit and loss account. To understand the principle of preparing profit and loss account. The determination of gross profit or gross loss is done by preparation of trading account, but it does not reveal net profit or net loss of a concern during a particular period. This is the second part of the income statement and is called profit and loss account. Profit and loss account starts with gross profit brought down from trading account on the credit side, if gross loss on the debit side. All the indirect expenses such as office and administration expenses, selling and distribution expenses, non-operating expenses are debited, and all the revenue incomes are credited to the profit and loss account, and then net profit or net loss is calculated. If incomes or credit is more than the expenses or debits, the difference is net profit. On the other hand, if the expenses or debit side is more, the difference is net loss. This net profit or net loss is transferred to the capital account of balance sheet. Profit and loss account is prepared to ascertain the net profit of the business concern for an accounting period. In the words of Professor Carter, profit and loss account is an account into which all gains and losses are collected in order to ascertain the excess of gains over the losses or vice versa. Now, it is important to know the indirect expenses which are taken to profit and loss account. Profit and loss account shows that only indirect expenses are taken in profit and loss account and deducted from gross profit. Such expenses include administration expenses or office expenses such as office salary and wages, insurance, rent, printing, postage, audit fees, law charges, repairs, etc. Selling and distribution expenses such as salesman's salaries, traveling expenses, advertisement, discount allowed, bad debts, warehouse expenses. Financial expenses, these expenses which are incurred for acquiring necessary finances for the business are called financial expenses. These expenses include interest on capital, cash discount allowed, bank charges, etc. Maintenance and depreciation expenses include repair to building, furniture, machinery, depreciation to building, furniture, etc. General expenses and losses includes losses on the sale of fixed assets, loss by fire, theft, etc., fines, charity, donation and gifts, etc. Miscellaneous incomes. It includes discount received, commission received, dividend received, bad debts recovered and income from investments. Now, debit side of the profit and loss account shows expenses, and these expenses can be classified into two categories: operating expenses and non-operating expenses. Operating expenses are incurred to operate the business efficiently. They are incurred in running the business organization. Operating expenses include administration, selling and distribution, finance, depreciation and maintenance expenses. Non-operating expenses are those expenses which are not incurred or associated directly with day-to-day operations of the business concern. They include loss on sale of asset extraordinary losses, writing off fixed assets such as preliminary expenses, underwriting commission, etc. Now, credit side of the profit and loss account include gross profit. Now, gross profit is the first item appearing on the credit side of the profit and loss account. Other revenue incomes also appear on the credit side of profit and loss, and the other incomes are classified as operating and non-operating incomes. Operating incomes. These incomes are incidental to business and earned from usual business carried on by the concern. For example, income received from discount, commission earned, interest received, etc. Non-operating incomes are not related to the business carried on by the firm. For example, profit on sale of fixed asset, refund of tax, etc. Closing entries for profit and loss account. For transferring expenses to profit and loss account, we have to pass the entry profit and loss account debited to expenses account. It means because expenses are shown on the debit side of the profit and loss account, so we have to pass the entry profit and loss account debited to expense account. For the purpose of transferring incomes to profit and loss account, the entry will be passed income account debited to profit and loss account. As incomes are shown on the credit side of the profit and loss account, that's why the entry is incomes account debited to profit and loss account. The balancing figure of the profit and loss account will be net profit or net loss. For the purpose of net profit, the entry will be profit and loss account debited to capital account. Because profit and loss account is transferred to capital account, and due to profit, capital increase. That's why the capital account is credited and entry is profit and loss account debited to capital account. And for the purpose of transferring net loss, the entry will be capital account debited to profit and loss account. Because capital is reduced or net profit is deducted from capital, so capital account is debited in this entry. It is important to note that in case of partnership, the profit and loss is divided between partners in their profit sharing ratio and credited or debited to the individual partners. In case of limited companies, net profit is transferred to profit and loss appropriation account for disposal. It means in case of sole trade, the profit will be transferred to capital account. But in case of partner, we have to divide this profit before transferring this profit to the capital accounts of the partners. And in case of companies, this will not be added in capital account. We have to transfer this amount to the profit and loss account for the purpose of disposal. Specimen of profit and loss is shown in this picture. It is given for providing a better clarity of profit and loss account. It is clear from the picture that starting point of profit and loss account is gross loss or gross profit. We will start with gross profit or gross loss, which is calculated with the help of trading account. If we have earned gross profit, it will be shown on credit side, and if firms are incurring losses, then gross loss will be shown on the debit side of the profit and loss account. Then expenses such as office and administration, salaries, rent and taxes, printing and stationery, postage and telegrams, telephone expenses, legal charges, insurance, audit fees, director fees, and incomes such as dividend received, interest received, income from investment, discount received, commission received, rent received, profit on sale of asset, sundry revenue receipts. For the expenses such as showroom expenses, advertisement expenses, commission paid to salesmen, traveling expenses, bad debts, provision for doubtful debts, go down rent, carries outward, upkeep of delivery man to depreciation and maintenance, repair to financial expenses, then interest on borrowings, discount allowed to abnormal losses, losses on sale of asset. All these are shown on the debit side of the profit and loss account. The balancing figure of this account will be either net profit or net loss, and this net profit or net loss will be transferred to capital account. Let us discuss the purpose and importance of preparing profit and loss account. The knowledge of net profit or net loss. The purpose of preparing profit and loss account is to ascertain the amount of net profit or loss. This is the actual profit available to proprietor and credited to his capital account. A certain ratio between net profit and sale. After getting net profit from profit and loss account, it is matched with the net sale to calculate net profit ratio. This ratio is compared with the desired net profit ratio, and if there is any shortcoming, that will be removed. This ratio can also be compared with the ratio of previous years, and effective future line of action can be taken. Calculation of expense ratio to sale. This ratio can be calculated by comparing it with previous year expense ratio and desired expense ratio. It will always be in the interest of firm that the expense ratio should be minimum. Comparison. The actual performance of business is available with the profit and loss account. As regards net profit, individual expenses, individual income, we compare our actual performance with our planned or desired performance to identify weakness and try to remove them. Maintaining provisions and reserves. Certain reserves and provisions are to be maintained to meet the future uncertainties. The amount of provisions, reserves and funds to be maintained depends upon net profit earned by the firm. It is necessary to prepare profit and loss account to determine the net profit so that effective provision for uncertain future can be maintained. Determine future line of action. Organizations can adopt future line of action on the basis of the information available from profit and loss account regarding net profit and other expenses. Principles are important guidelines which should be followed by preparing the profit and loss account. We must have the knowledge of principles which need to be followed by preparing profit and loss account. And main principles related with the profit and loss account are: the first one is receipt and expenses of revenue nature should be entered. When we have to prepare the profit and loss account, only revenue nature receipts and expenses should be shown on the profit and loss account. It means we have to ignore the capital receipts and expenses. Capital receipts and expenses should be ignored. Only receipt and expenses of revenue nature should be entered in profit and loss account. Further, expenses and incomes related to only to the period for which accounts are being prepared should be considered. If the expenses has not been yet paid in the cash or the income has not been yet received in the cash. All expenses of owner and partner must be debited to the capital account or the drawing account and must not be debited to the profit and loss account. According to this principle, the expenses which are of personal nature or the private expenses of owner or partner should not be disclosed in profit and loss account. These should not be taken in profit and loss account, and these should be shown in capital account or drawing account. Similarly, any income has been earned from the private asset of the proprietor which is received by firm, it must be credited to the capital account and should not be disclosed in profit and loss account of the firm. It is important to get the knowledge of items which used in the profit and loss account. The first item is salaries. Salaries paid to employees of the firm working in office. Salaries paid to workers of the factory, work manager, production engineer is direct expenses, so debited to trading account. Salaries and wages means indirect expenses, whereas wages and salary is a trading item. What it means? If wages and salary is given, it means it is a direct expenses and it should be shown in trading account. But if salaries and wages are given, these are treated as indirect expenses and shown in debit side of the profit and loss account. Rent. Rent of office, shop, showroom, etc. is an indirect expense and posted to the debit of the profit and loss account. Rent of factory building shall be, however, charged to trading account. The rent received is an income which should be credited to profit and loss account. It means the rent which is related with the office, shop or showroom is treated as indirect expenses and shown in the debit side of the profit and loss account, whereas rent of factory building is shown in trading account. Interest on loan, bank overdraft, capital is an expenses of indirect nature and debited to profit and loss account of the firm. Interest on fixed deposit, investments and loan advanced by the firm is an income and as such shall be credited to profit and loss account. Interest on proprietor's drawing should be treated as a separate item. Commission. Commission paid to the selling agents are indirect expenses. It is selling and distribution expense, so it will be debited to profit and loss account. Commission paid to agents on the purchase of goods is direct expense and posted to debit side of trading account. Insurance premium. The firm has to pay insurance premium against fire, marine and other policies. It is an indirect expense, hence it will be debited to the profit and loss account. Apprentice premium. Some firms undertake to train men in various trade for which they charge certain fees, and this fees is called apprenticeship premium. Life insurance premium. If the insurance premium is paid on the life policy of proprietor of the business, the amount will be treated as his drawings and it is shown by way of deduction from the capital account. It should not be taken to the profit and loss account. What it means, if life insurance premium is paid, it should not be disclosed in profit and loss account. It should be treated like a drawings and should be debited in capital account. Income tax. Income tax paid appearing in trial balance of a sole trader is to be treated as an item of personal expense of the proprietor. So it is deducted from the capital at the liability side of the balance sheet and it is not debited or credited to the profit and loss of the organization. Now, discount. Discount can be of two types. One is trade discount and second is cash discount. Trade discount is allowed at the time of selling goods. It is also known as off-season discount, New Year's discount, bumper sale festival discount. The amount of this discount is deducted from sale and no separate entry is required to be passed for this type of discount. Whereas cash discount is allowed at the time of making or receiving payments. If the payment is made immediately or at an early date company may allow its debtors certain discounts, and cash discount or discount is an indirect expenses and it will be disclosed on debit side of the profit and loss account. Loss or gain on sale of assets. There may be loss on sale of assets. So all losses should be debited to profit and loss account. It should be noted that loss on sale of asset is not operating loss. Profit or gain on asset is an income. So it will be credited to profit and loss account. In case of calculating operating net profit, company shall exclude profit on sale of assets from the credit side of the profit and loss account. Trade expenses. These expenses are also known as sundry expenses, miscellaneous expenses, and office expenses. These expenses are of nominal value. So it is not necessary to open a separate account for such small expenses, which are generally considered as petty expenses. Any other loss. Losses are the unwanted burden which the farmer may have to force to bear. These losses may be loss by fire or loss by accident or bad debts. These losses will be shown at the debit side of the profit and loss account. For the purpose of providing better understanding of the profit and loss account, information is given in this picture, and we have to prepare profit and loss account with the help of this information. We are provided with office rent, printing expenses, tax and insurance, discount received, advertisement, salaries, stationery, discount allowed, traveling expenses, and gross profit transferred from trading account. Now, first of all, we have to identify the item of income and expenditure. And there is no item of income except gross profit. The profit and loss account for the year ended on 31st March 2015 is disclosed in this picture. There are two sides, one is debit and another is credit. And the starting point for the profit and loss account is gross profit, which is transferred, which is calculated with the help of trading account. And we will start with gross profit. Gross profit is shown on the credit side. And all expenses such as salaries, office rent, stationery, printing expenses, tax and insurance, discount allowed, advertisement, traveling expenses are shown on the debit side of the account. The item of income, that is discount received, is shown on the credit side. So, for the purpose of calculating the balance of this account, credit side is compared with the debit side, and credit side is more than the debit side. It means income side, the income of the firm is more than the expenditure of the firm. And the answer is, the balancing figure is net profit, and we will transfer this net profit to capital account. The capital account will be credited with this net profit. So, with the help of preparing profit and loss account, a firm can judge whether it is earning profits or losses. The profit and loss account is also cleared with the help of another example. We are provided with the information: gross profit, commission received, interest received, sundry incomes, depreciation, salaries, discount debit, discount credit, bank charges, audit fees, and stationery. So, for the purpose of preparing profit and loss account, we have to identify the items of income. And the items of income are gross profit, commission received, interest received, sundry income, and discount credit or discount received. Whereas depreciation, salaries, discount paid, bank charges, audit fees, and stationery are the items of expenses, and these will be shown on the debit side, whereas items of the income will be shown on the credit side. The profit and loss account for the year ended on 31st March 2015 is disclosed in this figure. There are two sides of this account. One is debit side and another is credit side. Debit side shows all expenses and losses which are indirect in nature, whereas credit side include incomes which are earned by the organization. The starting point of this account is gross profit. The gross profit is calculated with the help of trading account, and it is the starting point of the profit and loss account. It is shown on the credit side of the profit and loss account. If the firm has incurred gross loss, we have to show it on the debit side. But in this example, we are given with gross profit, that firm is earning gross profits. That's why we have to show it on the credit side of the profit and loss account. It is the starting point. We will start with gross profit. It will be shown on credit side of the profit and loss account. After that, all expenses which are indirect in nature, such as depreciation, salaries, discount, bank charges, audit fees, stationery, are shown on the debit side of the profit and loss account. All these expenses are indirect expenses. These expenses does not include direct expenses, because direct expenses are shown on the trading account, the debit side of the trading account. Only indirect expenses, only the nominal accounts which are indirect in nature are shown in the debit side of the profit and loss account. Whereas incomes such as commission received, interest received, sundry income and discount received are shown on the credit side of the profit and loss account. After showing these items, we have to compare the total of debit side with the total of credit side. And in this question, this example, the credit side is more than the debit side, which indicates that the firm is running or firm is earning net profits, because its income side is more than its expenses side. If expenses side is more than income side, it shows that firm is earning losses. But in this case, this particular case, the firm is earning profits because its credit side is more than the debit side, its income side is more than the expenses side. And this net profit which the firm has earned is transferred, it's carried forward to capital account. It is added in capital account. The capital account is credited with net profit, because net profit is added in capital account. So this makes clear that if the firm is earning profits, then its credit side must be more than its income side, must be more than expenses side, and this profit increases the capital of that particular concern. So students, let us summarize what we have learned from this module. Net results of an organization can be known by preparing profit and loss account. All revenue expenses related to the year, whatever it is paid or not, and all revenue income related to current year, whatever it is received or not, must be taken into consideration in order to know the exact net results. The profit and loss account is opened in order to ascertain the net profit or loss. After the trading account, it is prepared. All other balances on nominal accounts remaining in the trial balance are transferred to profit and loss account. The first item of profit and loss account is credit by way of transfer of gross profit from the trading account. The transfer of nominal account balance on profit and loss account are made through the journal, and the entries are called closing entries. Closing entries are so called because they serve to close all nominal accounts in ledger. The profit and loss account is finally closed by transferring to the net profit or loss to the capital account of the proprietor. The credit balance of profit and loss account represents net profit, and as profit adds to the capital balance, it is carried to the credit of the capital account. The debit balance represents net loss, and as loss reduces the capital, the same is carried to the debit of the capital account.